Any truly accomplished investor will admit that there is one thing far more important than what stock to buy. They'll tell you that while anyone can hype up the next great stock pick, point to a chart, or tell people to buy, the pros are rarely focused on what stock to get long on. And I agree. The purpose of any good investment isn't to buy the asset. It's not even to own it. It's to sell it for a profit. In this video, my team and I found 3 real stories from real people who are struggling with this basic question. When is the right time to sell? I just lost $15,000 in profits from just this past month alone. The first thing I would suggest is... I'm Tom Preston, Chief Market Strategist for tastylive, and this is Money Makeover. Post number 1 asks, how likely is the stock market always to recover over a 5 to 10 year time frame? This is from Jason, and Jason says, I just lost $15,000 in profits from just this past month alone. And if the market drops any further, I'm going to see real losses in my portfolio. People keep giving the advice to hold on to the long-term outlook and the market will eventually go back up, but seriously, how likely is this? Aren't there periods throughout history where the market has remained stagnant for as long as nearly a decade? And is it possible for the stock market to never, ever recoup and go back up ever again? I'm going to assume that you had pretty good profits going into this summer a couple of months ago, and this last sell-off in the S&Ps cost you about $15,000 in profits. There's still profits in your investments, just not as big as they used to be. If giving back $15,000 is too much, then what you're doing is trading too big. Your position size is too big for your account. You've got to get that number down to where it's not necessarily comfortable, but where you can live with giving up that much profit. So the first thing I would suggest is take some money off the table. Now, one of the things that I like to look at is the probabilities based on the SPX. What I'll do to figure this out is go into the platform, go into SPX options, and then scroll down until I find options that have about 365 days to expiration. 350 is close enough. Then I'll look for a strike price about 8% below where the SPX is right now, and another one 8% above. So when I see that 29% probability for the put and the 46% probability for the call, what does that actually mean? It means that theoretically, there's a 28% probability that the SPX will be below 38.75 in 1 year's time. Alternatively, there's a 46% probability that the SPX will be above 45.50 at expiration in 1 year's time. Those numbers, while they're not guaranteed, can help you quantify your decision-making process. Post number 2 is my $10,000 penny stock portfolio. This is Josh, and Josh believes the key to his $10,000 penny stock portfolio success has been to have a diverse portfolio. He says, I usually keep my number to about 8 to 10 penny stocks. Why this magic number? Penny stocks are a gamble, but you can make it an actual investment if you use multiple tools. He invests in penny stocks that analysts are bullish on or that are getting hype in Reddit threads. He allocated about $1,000 to each penny stock that has a favorable narrative, 10% of his portfolio in each. And he says, I've been doing this with 8 to 10 penny stocks at a time, and I essentially haven't had any loss as a whole. Sometimes I break clean even, but more often penny stocks will usually give a 5 or 20% loss when going south, while other winners can give a 50% or 500% return, which greatly takes out the risk. He sets a 3 to 5 time profit target for winning trades, then reinvests those gains back into his diversified penny stock strategy. Okay, Josh, full disclosure, the first stock I ever invested in was a penny stock. It's back when I was in college. It was RCM Technologies. RCMT was the symbol. Why did I buy it? It was back in 1984, 1985. Why did I buy it? As I knew a couple of guys in the finance department who were talking about investing, and they said, RCM Technologies is a great company, got to buy it. So I took my, $100 or whatever I had. I didn't have any money in those days, and I bought 100 shares of RCMT. I think I held on to that stock through its ups and downs for 2 years, and I think I sold it for a $10 profit. Not 10 points, $10 total. Josh, I'm glad you're doing better than I am, but I have a couple of thoughts about this. From a theoretical standpoint, flash forward to when I was in business school, Gene Fama and Ken French, 2 finance guru wizard type guys, came up with this theory based on data that said small cap stocks outperform big cap stocks.
To me, it makes a lot of sense that small stocks and big and value stocks are riskier, and they have higher, as a consequence, have higher cost of capital and higher expected returns. It's like
why? Well, it's due to volatility. So because there's more uncertainty in these small cap stocks, cash flows, they have a depressed value. And because they're more volatile, they have more upside potential. Dimensional Funds here in Austin, Texas has built a whole company out of that idea. So Josh, you're not alone in getting involved with these penny stock things. So I don't necessarily criticize you with what you're doing, but there are 2 points that I want you to consider. First is, how repeatable is this? Just because penny stocks have worked for, let's say, most of 2022 or 2023, when the market's been relatively strong, what are they going to do when the market is not strong? It's down or flat. And what happens when Reddit dries up or analysts don't pick up penny stocks anymore to analyze? I think it's hard to make a living trading penny stocks like that. Yeah, people say they do it and you're having success right now. I don't deny that. But going back to repeatability, I'm a trader. I pay my bills every month with my trading profits, or at least that's the goal. And if it takes a year or more for a penny stock to pop, and even if it's a 500% return, I'm sitting there waiting for it. I can't afford to do that. Now the question is, when do you sell these penny stocks to get these high returns? You don't know. And it's human nature. Trust me, I've seen a lot of traders with the same mindset. If you see a 500% return, think, oh, maybe I'll get a 1,000% return or 2,000% return. And it doesn't happen, or it doesn't happen with any regularity, and it's not repeatable. I keep going back to this point. To make a career out of investing or trading, the results have to be repeatable and somewhat predictable. That's where options come in. Options let you quantify the probability of a profit. They let you define profits. They let you define your risk, something that penny stocks really don't do. So sure, okay, have a percent of your portfolio in penny stocks if you must. If that's really what floats your boat, okay, fine. But don't sink the profits back into it. You're not changing your risk profile at all. Take some of those profits, put them in option strategies, and start learning other aspects of how to make money in the markets. Post 3 asks, how do you decide when to sell a profitable stock from your portfolio? Bradley says, one of my stocks is up 50%. I have a good profit on it. Don't have an exit strategy at the moment and not sure how to make an exit strategy, especially since it shows no signs of slowing down. But I need a plan to sell, which I do not know how to. Can someone else explain the rationale and thinking behind selling a stock that has made them good gains? Okay, first of all, Bradley is hitting on one of the most important aspects of investing or trading is when you say there's no signs of slowing down, you have no idea whether the stock is going to go up or down from where it is. So hanging on to it is only continuing to take the risk on that stock. Yes, it might go up and make you more money. That's great. Or it might drop back down. Because you don't know the direction, or it's really hard to time the market. If you can do it, great. I can't. That means you need an exit strategy before you put the trade on. 3 ways that you could think about this, Bradley. Close the position, sell the stock when the reason you bought the stock is no longer true. So, you bought it for earnings, earnings have passed, take whatever profits you have. You bought the stock at the bottom of a range, now it's trading towards the top of its range. Okay, fine, take your profits and move on. This goes back to the idea of you just don't know where a stock is going to go from here on out. So take your profits. The reason you bought the stock turned out to be right. Whatever the profits may be, take them and move on to the next trade. The second is a little bit more specific and quantifiable. Set a defined percent target, both up and down. A third way Bradley could think about exiting that position is to sell an out-of-the-money call against his stock. So let's say a stock's trading at $100. If you sell the 105 call, if the stock goes up to 105, you've basically capped out your profits at $5. The other thing a short call against the stock does is give you a little bit of credit to reduce the cost basis of the position. How that works and why that's a benefit, you can learn about that in the video below. I've had a few people ask me if there's a way to time entry and exits in shorter time frames, like a few weeks or even a day. Now, I do have a strategy to win more than half your trades, but it's not something you hear on Reddit forums. To hear how I approach shorter time frames, watch our video on day trading.